Good morning, you magnificent morning melonheads. Happy Tuesday, everybody. Today is Tuesday, December 6th. I hope you are all well. Hi, Mom. Hi, Dad. I love you guys. There is not a whole lot happening in the world of finance today, but we did get I don't know if you want to say ominous. I think it's more, we'll say an ominous warning from Jamie Dimon, the CEO of the largest bank in the world, JP Morgan, today. Some might call it ominous. Some might say, Jamie, where have you been all year? Because he's saying he's warning that we could be in a recession by the middle of next year, which, if you ask anybody who really pays attention to the data, we've been in a recession all year long, Jamie Dimon, all year long. Yes, I know we got positive GDP numbers in the last quarter, but those numbers are due because they are artificially inflated based on the dumping of the Strategic Petroleum Reserve, which created artificial consumer confidence, which skewed all the numbers to mask what's really going on beneath the surface in the economy. The economy is not healthy. It is getting not healthier. And, Jamie Dimon is late to the party. But the crux of what Jamie said is that inflation is eroding the consumer. And if you've been following this channel for any amount of time, that will sound familiar to you because we've been talking about this for months here. People are spending everything they've got on their needs. They've got nothing left to buy their wants. And it's starting to show up. And we got a couple of data points, a couple of stories today we're going to talk about that all reinforces that, including some numbers that came out just in the last couple of minutes here. So we are going to bring in my man, Mish, the mod, and say hello. What is going on today, Mish? How we doing?
Man, I'm doing great. I am freezing my bow hiney off here in Lincoln, Nebraska.
Yeah,
And
I'm
I'm
sitting
hearing
here.
that Frank. Oh, hold on.
Yeah, I know we got sore throats all around. I had it last week. Apparently, you can spread it through YouTube because I was listening to Stephen Van Meter last night. I think he's got it going on now too. So I apologize. I am patient zero
Yeah.
for this.
Now, I've heard that Europe's not doing so hot right now. In fact, they're kind of in a cold streak like we are. So it's yeah, I think we're full in on winter now. And with Diamond talking today and Wells Fargo really talking also, it has not been a long-term news day.
Yeah, we had a warmer than expected autumn over in Europe, and the energy story really fell from the top of the headlines. Even on this channel, I was talking about energy and Europe almost every day a few months ago, and the story fell by the wayside. It didn't go away. They didn't fix the problem. It just got warm. I mean, it was Mother Nature. Well, not so much. We got some cold weather heading for Europe. It's really already arrived. It is really cold in my little corner office right now. I am shivering here, but that's all right because the thought of my Tuesday morning live stream keeps me warm on the inside. And let's take a look through the indexes while we're here. Why not? S&P right now is up 2.3 points. Really a flat day, just sitting right around the 4,000 mark. That's after the bloodbath yesterday. The Dow is currently down 16 points, fighting to get into positive territory. These are the futures, by the way. Market's not quite open yet. Dow had lost, 500 points yesterday? Tough day in the Dow. And the NASDAQ is currently sitting up 20 points or 0.17%. So even though markets are kind of flat, the fact that the Dow is down and the NASDAQ is up, to me, that says risk on. Okay, sure, risk on. Why not? What's the worst thing that could happen? Don't answer that. Over in the commodity space right now, we got a mixed bag. Looks like gold is up just a tick, about $7.90 or 0.44%. Silver sitting at $22.58, up 16 cents. Silver's had a heck of a run lately. Oil just got absolutely clobbered late in the day yesterday. I guess that's on some of this news coming out of China about a reduction in shipments, and God knows what's going on over there. We
Well,
did
they've
get some
been
big
weak
news.
in manufacturing for a while, and I think it's really starting to catch up to where the point that they have to open up before they're going to see it now. Not thread anymore. They have to actually do it because they're stringing us along. And remember, we still have OPEC Plus announcement kind of hanging out there that we haven't heard from them yet.
Well, we did hear Sunday night, no production cut.
Oh, did
We
that come
got
out?
no cut. Yes, that was Sunday night. I was very surprised. I put something out on Patreon. By the way, hi to my Patreon supporters. Link in the description should you feel so inclined. I was very surprised that Patreon did not. That Patreon, yeah, sorry, that OPEC Plus did not cut production. I was expecting a production cut, but they announced late Sunday that they were leaving it flat. Um, Now production is down because of the cut that they made back in October, so that cut is still in place. I was expecting an even deeper cut, especially after the announcement of the Russian price cap by the G7. I thought OPEC might come in and just decide to slap the West a little bit with another production cut, thinking they control prices, but they
Well,
didn't.
what we found out though is that one cut is about 700,000 barrels a day is what it comes out to. And we saw the release of the SPR decrease in November to only 1.4 million barrels or something really small. So I think we're stopping our release as a pretty please. And you see it in the numbers on the crude stock. We've been crazy going down. We were down 12 million barrels last week
Yeah.
alone.
So I remain very bullish oil in the long run. Now that the SPR releases, the last little bit of release is scheduled for this month, and then that'll be it. The SPR is down at historic lows. I mean, it's never been as low as it is right now. You know, they say it's the lowest level since 1984. Well, in 1984, that was the initial fill up period when we first built the reserve. So it's never been this low. Um, but you know, some of the data points, the health of the consumer, right? There's the demand side of things. I focus primarily on the supply side of things when I'm talking about why I'm so bullish oil. But you got to keep an eye on demand, and we're gonna get into some data points here that says demand may not be there. So, especially with this stuff going on in China, we'll get down to that. Natural gas sitting around $5.50. Keep your eye on natural gas prices, especially natural gas prices in Europe. I suspect within a couple of weeks we're all going to be talking about that again. It's now been about 4 months since that monster spike in energy prices over in Europe. And for most of this year and late last year, it was every 3 to 6 months we were having these big spikes in those Dutch TTF natural gas futures. Well, now it's been 4 months. We are very much due for a big spike in natural gas prices over in Europe, and it's getting cold. So don't be surprised to see that. On the bond front, we got yields are down pretty much across the board today. Check out some of the inversions though right now. The 10-year yield is sitting at 3.57%. We've got a 20 basis point inversion from the 1 month to the 10 month. That is amazing. The 1 month treasury is yielding 20 basis points higher than the 10-year treasury. I'm sure that's fine. I'm sure nothing bad is going to come out of that.
Well, the overnight is actually a little bit higher than the 1 month.
So even the overnight has flipped. That's right. The reverse repo, right? The reverse repo is yielding
Mhm.
3.8 right now.
Yeah.
So even the reverse repo has flipped the 10-year, has flipped the 1 month. So it's just backwards across the board. And again, nothing good comes from an inverted yield curve. We've been sitting on this curve for the better part of a year now. I mean, stocks are way down, but the inversion continues to get deeper. So bad things on the horizon from on the bond front. Let's take a look at the U.S. dollar, and my chart just went blank for a minute there. Here we go. All right, so I talked about this one in my video yesterday, the DXY, or the U.S. dollar index. We're at a very important technical level. We're sitting like right on it right now. 105.08. That was the bottom, the closing bottom from back in August. I have it right here. This is where we were back in August. It was also a resistance level back here in May. We putted around this issue a little bit. Now, we broke below this just a couple of days ago. It was a big technical breakdown. We also recently went below the 200-day moving average. If I'll zoom in a little bit on it here so you can see it a little better. And we're sitting right now, right in between these two lines, right at the 200-day moving average, right around this previous low from August. All right, and the dollar's trying to make up its mind where it wants to go here. The chart is telling me the dollar wants to go lower, sharply lower. All right, and that would be very bullish for asset prices if that happens. All right. Now you usually get a retest before you get any kind of a move below a support level. It looks like that retest is in progress, right? We've been challenging the 200-day moving average really for the last 3 or 4 days. But that story yesterday, You got to keep an eye on that story about the $80 trillion in FX swaps. And I want to add a little clarifying note. I saw a tweet from Brent Johnson today. Brent Johnson is the author of the dollar milkshake theory. I know it's a controversial subject. Some people feel very passionate about it, but Brent Johnson's had a pretty good year. Let's be honest here. Uh, this 80 trillion in FX swaps, that's not the trigger of a liquidity crisis. That's not the initiating event. You don't look at the 80 trillion and say everything's going to crash. What that $80 trillion pile in FX swaps tells me is that if something else triggers a crash, the crash is going to be much more violent and much more sudden than we realize, because there is trillions of dollars of daily demand for liquidity in the FX swap market. The world needs a lot of dollars every single day, constantly. I mean, and the short duration of this stuff, it's constantly maturing and rolling over. We need trillions of dollars of loans every day to keep this puppy fed. And if the lenders get nervous for whatever reason, in 2008 it was Lehman Brothers, in 2020 it was COVID. For any other reason, maybe COVID, or not COVID, maybe the crypto collapse, maybe Credit Suisse goes under, right? If for any reason the lenders get spooked, the liquidity squeeze will be instantaneous and it will be very violent. And that's the point I wanted to make with that video yesterday. And if that happens, we're going to see this DXY chart just go vertical straight up. It's going to incredibly strengthen the dollar. So the fact that there's this $80 trillion in FX loans out there, that in and of itself is not going to cause a collapse, but that's something that will make the collapse worse if something else causes it. Did I just confuse everybody more, Mish, or am I helping here?
Well, hold on. I think I'm muted. No, I'm not muted. Hey, so there's a little discussion going on about how is that compared to the long derivatives that are, well over a quadrillion. And my point being, and I think this is Jack's points too, is these are short-term loans being carried less than 6 months. So they're highly susceptible to interest rate changes. And when you're talking 80 trillion, the difference between a 1.5% loan and a 3.5% loan, that's a lot of money you're going to have to come with. That's almost $1 trillion a year in interest loan payments. That's different. You've got to use the chicken analogy to pay off loans. You can't use derivative money.
Yes, and it's the time element of it. How much is needed constantly? I'm going to use a chicken analogy, right? When I put a bunch of food in the chicken coop, I throw a whole bunch of corn and a whole bunch of table scraps in there, and they're all going scurrying and constantly eating it, right? And they're like voracious when I throw it in there. They go crazy for it. If I suddenly only throw in a little tiny bit, it's only going to be seconds before they fight over it. It'll be seconds. They'll be clamoring over each other for the little bit that I put in there. And that's how the economy, global economy, not the U.S., everyone in the world is global reserve currency. They all need dollars constantly. And if the flow of dollars slows, they'll start fighting over it. And by fighting over it, it means bidding up the price of it by bidding up higher and higher interest rates. So that's what you got to watch. And that could really send this chart straight up if we see some kind of breakdown in short-term liquidity. I got to say thank you very much to Steve Woitis. Thank you, Steve, for this super chat and the support of the channel. I appreciate that. He says, Ari, latest Dow run. When the bear yawns, I'm using the opportunity to remove my head from its mouth. I like that analogy. When the bear yawns, use the opportunity to remove your head from its mouth. Should you ever find your head in the mouth of a bear, be on the lookout for a yawn. That's good advice, Steve Woitis.
I'm going to keep that in the mental Rolodex.
I'm sitting here. I'm like, it's okay. He's going to yawn any minute now. But yeah, what you're saying, what Steve is saying there is he's taking advantage to lessen his exposure during this bear market rally that we're seeing in the Dow, and the Dow has had a heck of a run. I don't think the market has seen its long-term bottom. I know we've had a really good run, especially in the Dow for these last couple of weeks. This bear market rally has been substantial. We saw something similar in the summertime, only to have it correct lower. And the Fed is still tightening. Still doing quantitative tightening. They're still hiking. I know they're going to hike by less in December. Everybody's saying 50 basis points. Maybe we get a lower inflation read next week. I get all these things. But markets don't bottom while the Fed is still tightening. Tightening. It just doesn't happen. So that's I think that's probably a solid approach, Steve. And thank you very much for the support of the channel and for the analogy. I got a laugh out of that one. That was pretty good. All right, let's get into the story of the day. My man, Jamie Dimon. There he is. This is in CNBC. Jamie Dimon says inflation is eroding consumer wealth and it may cause a recession next year. I'm not going to rehash the whole thing. We're already in a recession. I don't care what the data says. When you dump hundreds of millions of barrels from your savings account to make it look like economic growth, that is not economic growth. That's economic stupidity. But getting into this one, JP Morgan Chase CEO Jamie Dimon said that inflation could tip the U.S. economy into recession next year. While consumers and companies are currently in good shape, I question that statement. That may not last much longer. Dimon said Tuesday on CNBC's Squawk Box that consumers have 1.5 trillion in excess savings from pandemic stimulus programs and are spending 10% more than in 2021. And Mitch and I were talking about this. We didn't quite get to the bottom of it beforehand, but this 1.5 trillion in excess savings number, maybe that is true on some technicality, but no way. Everybody watching, do you feel like you've got excess savings right now? Does the average consumer, do you think the average person feels like they have excess savings to the tune of $1.5 trillion? No way. All right, maybe that money is sitting out there in some Fed statistics about money market funds or something that says that money's out there, but I am willing to bet that money is in the hands of very few people who will not be in a position to maintain consumer spending, not for the rest of us. I think most of that saving. Go ahead.
If you dig into this a little further, because he's kind of talking about a Federal Reserve paper that came out in October, which is a lot worse of a read. I'm not going to lie there. But that paper says is that the 1.35 trillion of that is somewhere in the upper half. They don't really define upper half. I don't think they're talking about 50. They're probably talking more like 10 or 5%. Those people are holding 1.35 trillion of that. So everyone else is fighting over 150 billion of excess savings. And you have 2 super chats.
Oh, okay. We are falling behind. And where are we at? Hey, there's my man Mike Bender from Overlooking Models. Thank you, Mike. He says swap the interest rate risk on 80 trillion of loans. Math dictates that rates need to come down a lot within 6 to 12 months or everything is going to pop. You know, that is the most likely outcome here, Mike. I think if that liquidity squeeze does happen, the Fed will instantly, I don't know about instantly, they'll do what they've always done. They'll try to extend swap lines. They'll start doing their QE again, and they'll probably start cutting. And you know, it's what they've done every time. I'm not saying it's the right decision. It's probably not what I would do. Although, you know, what I would do probably wouldn't make me any friends if I was in charge of the Mellon Fed. But yeah, rates do need to come down. They shouldn't come down. Rates need to stay higher in order to have a free market. But to keep this debt circus alive longer, rates would need to come down. And the numbers need to keep getting bigger. That's the problem with this Keynesian experiment and this great balance sheet expansion, the law of large numbers. The rates need to constantly go lower, and the QE needs to constantly get bigger in order to keep the thing fed. And that $80 trillion number just goes to show. I mean, I think they said it was like 50 trillion in 2016 or something. So, I mean, it's growing at such an alarming rate. And look, folks, the base money supply, the amount of actual currency in circulation plus reserves at the Federal Reserve, it's only like 5.6 trillion or something like that. I mean, we're talking about this is more money than all the money in the world. Several times that. And
I think someone said that if you took all of M1, which is about 31 trillion, you can't pay this off with every dollar in existence.
Absolutely. So the world needs more dollars. The world wants more dollars. And every time they get short, the Fed is happy to oblige. And that's probably what they're going to do again here.
So I
it's
think
not going to solve the problem.
A good analogy here is if you look at the COMEX numbers and you see that the options owned are 234% of what actually exists. That's essentially what we have going on in the dollar market.
Yeah. And what does the COMEX do when physical supply gets tight? They create more paper.
Yeah.
Right. That's probably what the Fed will do again. But thank you very much, Mike. I appreciate the super chat. And by the way, Robin RC Models, in all of our Patreon calls and in a lot of the messages here, I got to give you credit, Mike. You have been warning about currency swaps and FX swaps for a long time now. And I remember I meant to give you credit in that video yesterday. I'm sorry I didn't. I was struggling to get that video out yesterday because it's a tough subject matter, and to try to phrase it in a way that most people can follow was not an easy task, and a lot got lost in that. But Mike has been warning about these FX swaps for a long time now. So very well done, Mike. I got to give you credit for that one. Good job, sir. And thank you very much again for everything you do for the channel. And Tim Duffy, thank you, sir, for the support of the channel. He says, I remember FedEx earnings last quarter. It kicked off a big drop everywhere. Ooh, next earnings is 12/20. Play it again, Sam. You know, I am going to write that one down. That's an important date to watch. FedEx earnings. Good stuff, Tim Duffy.
How's FedEx doing? That's what everybody's always wondering. Because if FedEx is tanking, so is everybody else.
Yep. And hey, we saw the article last week or 2 weeks ago. FedEx is furloughing their employees right now. They're furloughing their employees in December. I mean, don't people historically ship a lot in December? I just throw them out there. You guys do what you want. I mean, the fact that FedEx was furloughing employees and Amazon was laying people off heading into Christmas is so bad. That is such a bad economic indicator, such a big red flag. And yeah, you know, FedEx earnings on 12/20, I don't think they're going to be good. Not by any means. I think we're going to get not just a bad number, but a big warn about the numbers to come from FedEx, because we're going to get a little bit more into some of the data. Already at the very far end of the supply chain, we're starting to see things slow way down, way down. Not just a little bit. I mean, really big time slow down. So that will work its way up the chain into FedEx and that last mile delivery. So that's a good point. And be on the lookout for that 12/20. We may have to revisit this later on and say, hey, Tim Duffy called this one. Somebody remind me of that if it happens. Thank you, Tim. I appreciate the super chat, sir.
We've got a lot of stuff starting to pile up about a second half of 2023, something going on. You know, the Fed is already lined up to basically stop the increases by the middle of 2023. That's what they're talking about. You've got the heads of banks saying, look out for the second half of 2023. We have the manufacturing number dying. Second half of 2023 is really starting to solidify as where we might have some issues in this. So we're kind of in this down market here. Yeah, we're in a rally right now, but so let's just first say a what ifism here. This market keeps bouncing up and down like bear markets do, and then we crash. So then we crash from a lower number already. Yeah, this keep a close eye on some of the stuff out there.
What's really going to do it, and this is where I was going with that video yesterday, when we get some initiating event that makes the lenders nervous. All right, right. The lenders are right now, they're getting more nervous, but the lenders are still lending. They're just lending less and they're charging more for it. When we had the Repo Madness event in September of 2019, when after the Lehman collapse, the lenders didn't get nervous. The lenders went on absolute defense, right? They stopped lending outright and the credit system froze. And at that point, whoever had money was okay. Whoever didn't was done. And that's the big risk here, is a freezing in credit markets. And that's why, you know, we go from we're going down to take the elevator straight down. That's a credit freeze. That's when everybody panics. And that's when the Fed turns the money printer on. Because everybody will immediately forget about inflation when that happens, and we will beg the Fed to turn the money printer back on. Let me just read a little bit more off of this Jamie Dimon article here. He says, inflation is eroding everything I just said, talking about the savings and the strong household numbers. And that $1.5 trillion will run out sometime mid next year. I think that's deceptive, but Diamond said it may very well derail the economy and cause a mild or hard recession that people worry about. We're already in a mild recession, all right, and you could debate whether we're already in a hard recession. There's data to support that we're in a hard recession, but I'm going to say we're already in a mild recession. All right, he's repeating some political talking points here to a certain extent. Um, but when he said that trillion and a half will run out sometime mid next year, it's not going to go to zero because you're going to have a certain number of wealthy individuals who control most of that 1.5 trillion who aren't going to lose it all. It's the millions, the tens of millions of people who are between 1.5 trillion and say a half a trillion. It's all of those people that go to zero between here and now. That's what is going to cause everything to sink. That's the consumers. And again, most people don't have that savings cushion right now, and if they do, it's very small. And this 1.5 trillion in excess savings, this number is very deceptive because a very small number of people control the lion's share of that money. That's the only thing. And look, here's some data to support it. This just came out today. Shout out to Mish. He caught this one. He's always watching the economic calendars. He's so good with the data. Thank you, Mish. U.S. United States Red Book Index, all right, which the Red Book Index, this is a sales weighted year over year same store sales growth. All right, this is how is the average store doing versus last year. All right, and this is not adjusted for inflation. So right now, same store sales increase in the U.S. at a rate of 5.7% in the last week. This is weekly numbers taken versus the same week last year. 5.7% does not keep pace with inflation. So the average store in the United States, adjusted for inflation, is doing less business than they did a year ago. They're selling less stuff. Americans can afford less, right? There's no shocks here. There's no big surprises here. This is inflation hurting the consumer, and the U.S. is a 70% consumer-driven economy. So this is a very big deal for the health of the consumer. And this is Christmas shopping season. Again, this is the time of year when people are typically ramping up their spending. But what you really see is when you make this a 5-year chart. Let me set this to a 5-year line chart. And now you can see it a little more clearly, right? Here's the pandemic, right? Forget this big dip. The pandemic always messes with everything. And then people spent more money as the stimmies piled up. But look how this chart has rolled over. And look how it is now accelerating downward with time. The problem with the consumer is getting worse, and it's getting fast. It's getting worse faster. It's accelerating downward. And very soon we are going to be in negative, not just negative real, negative nominal numbers because people are going to be broke and the credit cards are going to get cut off. And right now, people are not making the adjustments needed to their lifestyle to compensate for inflation. And Jamie Dimon was somewhat alluding to that the savings is being whittled down. People aren't making changes necessary to adapt to more expensive stuff. They're just putting it on the cards. They're just spending down their savings. And this is going to blow up in their faces. So this is another one that says, look, the health of the consumer is not doing so good. I think I missed a super there. Where are we? There he is. Hey, Mike. Mike is back again. He says, by the way, big serious political discussion in Germany. Okay, danger. I'm getting my danger political alarm is going off. Abolishing cash in favor of CBDCs. Oh boy, don't get me started. Going on right now. Someone is worried. Does that trigger you, Jack? No, I'm not triggered. Why would I be triggered? What makes you think I'm triggered? I'm not triggered right now. I'm totally not triggered. I'm very triggered. Incredibly triggered.
So, it's about the CBDCs. So we have in the United States, the Senate is attempting to push through the Safe Banking Act again. And it has a lot there, and I won't get into why that's great for Colorado, but the tenet is whether or not they're going to include language for a CBDC. This would be the avenue to do it.
Go figure. What they're going to do, they're going to bury in a piece of legislation that makes legal something that should have been legal all along. And in order to get it, and the only reason they're doing that is to absolutely enslave the population. Isn't that just like powerful people? A central bank digital currency is a tyrant's wet dream. It is the worst possible thing that could ever happen for the average person. Nero, Caligula, Napoleon, the guy with the H. You put all those guys together in a room and dream up their worst possible scenario, and you describe a CBD to them, CBDC, they would love it. Oh my God, they're like, you can do that? Oh my God, that's great. It's a default on money, all right? Written on every dollar bill, every piece of currency, it says this note is legal tender for all debts, public and private. All right? And if they push a CBDC, it will be a default on cash, a default on the US dollar, because it'll be saying you can spend this US dollar on anything you want just as long as we say it's okay. So, am I triggered? Boy, howdy, am I triggered. Oh, yeah. Thank you, Mike. I guess I know you're over there giggling right now. Let's get Jack all spun up. Let's see if we can trick him into getting on his soapbox. Consider that button pushed, my friend.
Well, I'd like to point out that I helped push that button.
Yeah. Are you guys in Discord right now? Like, you want to see if we can have some fun with Jack?
Hey, so Mike sent me a quote from John Dimon this morning. What is
Dimon.
his name? Jamie Dimon this morning, where he called crypto a pet rock.
Okay. Well, I mentioned this on the Twitter Spaces with Swan. By the way, thank you to Swan for having me on.
Well, hold on. Let me explain the pet rock comment for those viewers that didn't have pet rocks. Back in the 80s, a company came up with the idea of selling pet rocks. Legitimately, it was an idea. It was kind of a craze, and people bought rocks. And now everything is now a pet rock because it doesn't do anything.
It's a gigapet that didn't even need batteries.
Yeah.
Pet rock, literally a rock that you could name.
It was worse than Beanie Babies.
The marketing coup is what that was. But of course, Jamie Dimon hates
you can sell anything, though.
Yeah. Now I would say crypto is pet rock, right? FTT tokens were pet rocks. Terra Luna was a pet rock. Algorithmic stablecoin, gag me that it was garbage. But Bitcoin, no. And if they push CBDCs, it is going to be rocket fuel for Bitcoin adoption. Because once you turn people's money off, people are going to need to transact one way or another. And you're going to create a black market for everything. And that black market is going to need a currency. And it's going to be metals and it's going to be Bitcoin. So if you default on the dollar, don't be surprised when people don't want to play by your stupid rules. But thank you very much, Mike. I appreciate the super chat, sir. I appreciate the support of the channel. And thank you for pushing my buttons and getting me all spun up this morning. I know you guys are having fun with me. All right, there's another story out there that really kind of paints a picture of what's going on with the health of the consumer, namely the U.S. consumer, but not just in the U.S. This is a couple days ago in Bloomberg. China factory orders drop, an ominous sign for global outlook. There's that word ominous again. Just use that today. Demand for tents to zippers drops as inflation hurts consumers. All right, tents and zippers, that's awful specific. I think they meant to be random with their words here. COVID zero ructions mean China's economy faces uncertainties. Investors wanting to gauge the health of global consumer sentiment should look no further than China's factories right now. Makers of Christmas decorations to clothing and tents say orders from overseas customers are drying up, with some predicting the best they can aim for is flat demand versus last year. Keep in mind that is nominal amounts. According to more than a dozen export managers interviewed by Bloomberg News, the snapshots from factories in key Chinese hubs indicate households worldwide already tightening their belts to contend with a rapid rise in the cost of living may be cautious for longer and adds weight to warnings about a potential global recession. Again, this potential recession talk moving on. Consumers don't have the money to spend with soaring inflation, and the decline in demand has happened suddenly, said Wendy Ma, marketing manager at a textile maker in the eastern city of Ningbo. Orders for items including buttons, zippers, and sewing thread dropped about 30% in July and August from a year earlier, and demand from major markets like the U.S. and Europe declined, she said. So the consumer all over the world is buying less stuff, and you're starting to see it in China's factories. By the way, that whole China real estate thing, that is still going on, folks. Just because we haven't been covering it, just because they've papered it over for the time being, don't think that's not still out there. And now you got a slowdown in manufacturing on top of that. Oh, things in China are not looking good. But we talked about FedEx a little while ago. If the factory orders in China are down in some cases 40% year over year, that's going to affect that last few mile delivery here in the States. That's going to affect FedEx, right? Because you're going to have less stuff being loaded on the ships. You see that. It's cheaper to move a cargo container across the ocean than it was a year ago. Far cheaper. You're seeing fewer boats making the trips. I saw a story Stephen Van Meter mentioned in his video last night that they're canceling routes. Like these giant freighters they're just not sending the ship. That's going to mean fewer planes, fewer trucks, fewer trains here in the States. That means less FedEx. That means less stuff moving. That means the American consumer is buying much, much less. And the consumer drives the economy, folks. And I have got my friend Dan Hedin. Thank you, Dan. He says FEW backwards, just firing Jack up a little more. That's what they do. And I'd love to go on a rant about the FEW backwards, but we don't talk about Bruno. That's how Jack gets in trouble. Every time I have mentioned the FEW backwards in any negative context on this channel, I have been the proud owner of a brand new shadow ban. And there has been zero channel growth for Jack for the ensuing 30 days. It has happened at least 4 times this year. So, man, talk about pushing my buttons. You guys are like, come on, Jack, get yourself in trouble today. Run your mouth. F around, find out, Jack. I am not a big fan about that organization, and I'm probably going to reserve all of my rants on the subject to Twitter videos from now on because, well, you can just say things on Twitter that you can't say on the tube anymore. So I will be devoting more time to putting out video on Twitter in the future. I'll probably do right now you can only post really short videos on Twitter, like the 99-second FTX video. That was basically custom made for Twitter. But
so I think
call that a hedge against the censorship.
I've seen someone said something in chat, and I'm sorry, I don't remember the name, about how people in more affluent tax brackets, if you will, are starting to move towards Aldi's and some of the more discount-oriented shopping arenas for groceries. And we've talked about that, how we're starting to see that migration from some of the more affluent fresh farms, things like that are more expensive, and they're starting to cut their costs where they can, and food being the first.
Yeah, affluent shoppers buying food at Walmart. Things you thought you'd never say for 1,000, Alex. Rich people buying their food at Walmart. I saw the same article. It was Aldi's and Walmart. The cover of that article had Aldi's on it, but I've seen the same story a couple of times now in a few different formats. And thank you, Stacey Taylor, who was in the chat saying, what's your Twitter? My Twitter is at JG_nuke. And there's actually a link to my Twitter feed down in the description below if you want to follow me out there. Also, I think there's a little icon somewhere on the screen. YouTube shows it. But I don't know exactly where to find it right now. But definitely a link in the description. And yeah, I'm going to be spending a little bit more time on Twitter because you're allowed to criticize certain people. And let's be honest, if you want to know, my old boss over on the nuclear side, really smart guy, very wise man. He once said to me,
I hate to interrupt, Jack. Say hi to Chris and Stacy.
Hi, Chris and Stacy.
Stacy
Chris is here too? Yeah, I said hi to Stacy.
Okay.
I just mentioned Stacy. But my old boss, he said, if you want to know who you really work for, find out who you're not allowed to criticize, and that's who you work for. And that just leaves a really bad taste in my mouth because I am not allowed to criticize these people on this platform. And so I guess, according to my old boss, that means I work for them. Gross. And I hate to self-censor, but if I say it too much, I'm going to get myself in trouble, and there will be no channel. So I'll be over on Twitter bad-mouthing them from now on. And thanks, Stacy, for pointing out that I got to mention my Twitter handle. And, hi, Dad. I see Dad is in the chat, too. Everybody say hi, Dad. Don't comment and drive, Dad. Dad's headed to the house today. All right, what else we got today? Speaking of bad things in China, Apple explores moving some iPad production to India, sources say. Apple's a little late to that party. the writing has been on the wall for a while now that Apple needs to get their butts out of China. But rather than close their factories, it seems they've been more willing to, I don't know, disable the airdrop feature to try to snuff out protests at the behest of communist tyrants. But Apple is definitely not on my nice list this time of year right now. I'm not a big fan of this organization. So yeah, they want to move to India. That's probably the right choice because look at everything that's happened in China over the last year. The way they've locked down the factories, man, they've turned Apple's labor into basically slave labor. It's not Apple's labor; it's Foxconn's. Foxconn's just an intermediary. So Apple is looking at moving their production out of China. I think that's a trend we're probably going to see more and more of, and not just China, but actually all over the world. Because check this one out: Taiwan Semi is upping their investment in an Arizona chip factory to 40 billion. They previously announced a $10 billion facility in Arizona. Now this isn't moving out of China. Taiwan Semi, they're obviously in Taiwan. They're the biggest chip maker in the world. Now they're building a $40 billion chip factory in the Arizona desert. Right? So, well, first of all, let me say this is very good for the United States in the long term because we need to shore up our supply chain. Semiconductors is a big vulnerability. You could argue they're almost as important as oil now, almost, not quite. But this is also a trend that is going to contribute to longer, more entrenched inflation because chips made in Arizona are going to cost a heck of a lot more than chips made in China or Taiwan. They just are. The labor is going to be much more expensive. The compliance costs are going to be much more burdensome. So this is one of those things that makes me think inflation is here to stay for a little while. Even though if we get this big, rapid deleveraging and debt goes belly up by the billions and the trillions, yeah, we're going to have deflation caused by a market crash. But this is going to be an inflationary force probably for the next 10 to 20 years at least. All of this reshoring and bringing back of manufacturing to the U.S. It's going to require them to hire more American labor. It's going to put more upward pressure on wage inflation. So this is a another one of those trends to watch. We also had, I think it was Micron is building a similar factory in upstate New York, tens of billions of dollars in chip manufacturing. Again, it's long overdue, but it's an inflationary pressure. So keep an eye on that one. And I think I can take down the WEF now before I get myself in trouble. Thank you, Dan Hedin, for the super chat and the support of the channel. And let's see. Let's go back through the indexes now. We got markets have been open for a little while. Let's take a look at what we got. The S&P is currently down 21 points or 0.5%. Opened a little bit in the red. The Dow is now into negative territory, down 69 points or 0.21%. And the NASDAQ leading the way lower, down 100 points or 0.96%. So the markets got wind of something they did not like this morning. And by the way, I just saw this come through right as I said that. Hey, Dan Hedin, you are so right, brother. The markets are all red this morning. I had to guess, I would say the DXY is probably green then. Let's see. I haven't seen this yet. DXY is currently at 105.9. It's just barely green. Just barely. 105.19 on the Dixie. So the dollar strengthening, that means the prices of assets denominated in dollars are heading lower. Probably seeing something similar in commodities. Not so much. Gold is up $6. Silver's up about 18 cents. Oil now only down about 28 cents. WTI at 76.64. So, look, not a very eventful day going on right now. We got some economic data that says the consumer is in trouble. We've got some stories about a reshuffling of the supply chains and production overseas. So, the bad news is still out there, but it's not going to happen today, whatever it is. It's not going to be a today kind of thing. So, we're kind of in this hurry up and wait scenario here. I mean, that's kind of what I take away from all this, Mish. What are you seeing today? Anything different?
Not really. I mean, today really feels like let's everybody take a breath. And okay, I don't know how many fans of the Tour de France are out there, but in the morning when they start off, they kind of make a decision as a group if they're going to have a hard day or an easy day, and they don't follow that decision, but they may take it easy for the first couple hours as a consensus decision. And that kind of feels like what we're having here today because everybody's taking a breath.
Yeah, and everybody's waiting for that inflation read next week. That's probably going to be your next market moving event, unless some other sudden thing happens. But it's probably CPI on the 13th, which is that next Tuesday. Yep, that is next Tuesday, and we also have the FOMC next week. So, that's going to happen right as the inflation comes out. So, it's hurry up and wait. But look, I think we're going to wrap it up there. Again,
I do
not a
want to
whole
say
lot
hi,
here.
Mom. Your dad did say that your mom's listening, and she'd be
Oh,
nice
hey,
to
mom.
say wait to say hi, Mom.
I said hi to mom and dad as soon as we started this bad boy. I didn't forget about mom and dad today. Definitely got them right away.
Yeah, let's not
Also,
forget
I
about
said hi
Mom.
to the yeah. Also, I said hi to the Patreon folks, and looking forward to talking to you guys tomorrow on our weekly Zoom call. Again, there is a link down in the description below to that. Hopefully, there's a little bit more going on in markets by then, because man, I'm struggling to fill the air today. We're not going to fill the air with crap, so we're going to call it there. Mitch, you got any final words?
Take it easy, stay safe, and look for Merc.
All right, guys. Thanks for everything. And until next time, live small and dream big.